For years, we've been told to max out our tax-advantaged accounts. The promise is irresistible. Grow your wealth, pay less to the government, and secure your future. It sounds like a financial superhero, a silver bullet against the dreaded taxman. These accounts, from 401(k)s to IRAs and HSAs, are foundational pillars of mainstream financial advice, universally lauded for their seemingly undeniable benefits. But what if this widespread acclaim obscures a more complex reality? What if the very mechanisms designed to save you money are simultaneously imposing a hidden cost, silently eroding your potential without your full awareness? We often focus solely on the tax benefits, deferral today, or tax-free growth tomorrow. Yet, like a sleek sports car with exorbitant maintenance, these accounts can carry an unseen price tag. This isn't just about explicit fees, which we'll address, but also about the subtle trade-offs that financial analysts and economists increasingly scrutinize. The true cost extends beyond direct monetary charges, encompassing aspects like reduced flexibility, limited control over investments, and even the psychological burden of navigating complex regulations. It's a nuanced picture, challenging the conventional wisdom that tax-advantaged automatically means optimal in every scenario. Here's what most people don't consider. While these accounts offer tax advantages, they often come at the cost of asterisk control star. Imagine owning a house, but needing permission to paint a wall, or being told which furniture brands you can buy, and facing a penalty if you move out too early. This might sound extreme, but the parallels with certain tax-advantaged accounts are surprisingly apparent. Financial researchers observe that the perceived freedom of tax savings can mask underlying restrictions on accessing your capital, choosing investments, and even dictating when you must withdraw funds. This trade-off between tax efficiency and personal financial sovereignty is where the hidden costs truly begin to emerge. Let's start with a concrete example, the 401(k). While the immediate tax deduction feels like a win, many participants are unaware of the fees quietly eroding their returns. Economic studies frequently highlight how employer-sponsored plans, particularly those for smaller businesses, often feature higher expense ratios on underlying funds compared to what an individual could access in a retail brokerage. These fees, which can encompass administrative, record-keeping, and investment management charges, might seem minor on a percentage basis. However, their cumulative effect over decades of compounding growth can be staggering, a silent drain on your retirement nest egg. To illustrate this invisible drain, consider a hypothetical scenario compiled from various financial analyses. A modest additional 0.5% in annual fees might not sound like much. However, over 30 years, on an initial investment of $100,000 growing at an average of 7% annually, that seemingly small percentage can accumulate significantly. The difference between 0.5% and 1% in fees can translate into a substantial sum lost to charges rather than compounding for your benefit. This effect is often underestimated, as the power of compounding works against you with every basis point of expense. Research from organizations like the Government Accountability Office and independent financial watchdog groups consistently points to a wide disparity in 401(k) fees. Some plans, particularly those sponsored by smaller employers, may offer a limited selection of funds with expense ratios significantly above industry averages for comparable investments. In contrast, large institutional plans often leverage their buying power to negotiate lower fees. This disparity means that two individuals, contributing the same amount to their 401(k)s, could see vastly different net returns based solely on the fee structure of their respective plans. It highlights that tax-advantaged doesn't equate to cost-efficient by default. Beyond fees, many tax-advantaged accounts impose strict rules on when and how you can access your money. This is the lockup cost. Retirement accounts like 401(k)s and IRAs are designed for the long haul, often restricting withdrawals before age 59 and a half. While this encourages disciplined saving, it also means your capital isn't as liquid as money in a standard brokerage account. Life, however, is unpredictable. Emergencies, career changes, or unforeseen opportunities might demand access to your funds, leading to a financial dilemma: pay the penalty or forego the funds. This inflexibility can be a significant, unquantified cost. Imagine needing funds for a critical medical expense or to prevent foreclosure, only to realize that withdrawing from your 401(k) before retirement age triggers a double whammy. ordinary income taxes *+ an additional 10% federal penalty tax. While some exceptions exist, such as for certain medical expenses or first-time home purchases, they are often narrow and complex. This punitive structure, as described by IRS regulations, effectively holds your capital hostage for decades, even as life throws unexpected curveballs. The emotional and financial stress of these penalties represents a very real, if often overlooked, cost. To underscore the severity, consider the typical early withdrawal penalty, a flat 10% federal excise tax on top of your marginal income tax rate. For someone in the 22% federal income tax bracket, withdrawing $10,000 prematurely could mean losing $2,200 to income tax and another $1,000 to the penalty, totaling $3,200 instantly, not including state taxes. Financial advisories routinely caution that this significant immediate reduction severely diminishes the benefits of prior tax deferrals, making early withdrawals an incredibly costly last resort. The bite is immediate and substantial, highlighting the true illiquidity of these funds. The choice between a traditional IRA of 401(k) and a Roth IRA of 401(k) presents another hidden cost, a gamble on future tax rates. With traditional accounts, you get a tax deduction now, but pay taxes on withdrawals in retirement. Roth accounts offer no upfront deduction, but qualified withdrawals are tax-free. Financial economists and tax experts note that this decision hinges entirely on whether you believe your marginal tax rate will be higher or lower in retirement. It's a speculative endeavor, and getting it wrong means you could pay more in taxes overall, nullifying some of the supposed advantage. No one truly possesses a crystal ball to foresee future tax policy. Government needs, demographic shifts, and economic conditions can all influence tax rates over the decades your money is invested. What if you diligently funded a traditional IRA, believing you'd be in a lower bracket in retirement, only for tax rates to surge? Or vice versa with a Roth? Analysts frequently point out that the certainty of today's tax deduction or tax-free growth can be more appealing than the uncertainty of future tax policy. The hidden cost here is the risk associated with this long-term tax rate prediction, a gamble inherent to these choices. Another often overlooked cost, especially in 401(k), is the severely limited investment menu. Unlike a self-directed brokerage account where you can invest in virtually any stock, bond, ETF, or mutual fund, 401(k) typically offer a curated, often restrictive, selection. This limitation means you might be unable to invest in a specific low-cost index fund you prefer, or a high-growth sector you've researched. As financial advisors often lament, plan administrators choose the available funds, and their choices don't always align with your optimal investment strategy, potentially forcing you into less efficient or higher cost options. This restriction directly leads to an opportunity cost. In economics, opportunity cost is the value of the next best alternative that you didn't choose. By being forced into a suboptimal fund within your 401(k), perhaps one with higher fees or underperforming assets, you're implicitly giving up the potentially higher returns or lower costs you could have achieved elsewhere. If you invest $10,000 in a fund returning 6% because it's the best available in your 401(k), but you could have invested in a similar fund returning 7% in a taxable account, that 1% difference, compounded over decades, becomes a significant loss. This foregone gain is a hidden cost, often far outweighing any immediate tax savings. Consider two hypothetical investors, both contributing $5,000 annually for 30 years. Investor A's 401(k) has limited options, forcing them into a fund averaging 6% annual returns after fees. Investor B, using a taxable brokerage account with more choices, selects a similar asset allocation fund averaging 7% annual returns, even after accounting for capital gains taxes on distributions. Over 3 decades, that seemingly small 1% difference, as shown by financial modeling, can accumulate to tens or even hundreds of thousands of dollars. The tax advantage in Investor A's account might be offset, or even overshadowed, by the superior growth in Investor B's more flexible account. This illustrates the profound impact of opportunity costs. Numerous studies, including those by S&P Dow Jones Indices, consistently demonstrate that a significant percentage of actively managed funds underperform their passive benchmarks over extended periods. Yet, many 401(k) plans predominantly feature actively managed funds, often with higher expense ratios, rather than low-cost index funds. This creates a double whammy: higher fees and a higher likelihood of underperformance. While individual results vary, the statistical evidence strongly suggests that being restricted to these choices within a tax-advantaged wrapper can be a substantial long-term cost, potentially negating the tax benefits. It's a compelling argument against blindly accepting default options. The government gives you tax deferral, but eventually, it wants its share. This comes in the form of required minimum distributions, or RMDs, which force you to start withdrawing money from most traditional retirement accounts, including 401(k), S and IRAs, once you reach a certain age. The SEC and IRS jointly enforce these rules, meaning you lose control over the timing of your withdrawals. Even if you don't need the money, you must take it, potentially pushing you into a higher income tax bracket in retirement and negating years of careful tax deferral planning. This is the government's deferred tax clawback, a structural cost inherent to these accounts. The RMD paradox is this: you've successfully grown a large retirement nest egg through disciplined saving and tax deferral, which is a commendable achievement. However, that very success triggers a mechanism designed to extract taxes. For many retirees, particularly those with other income sources or sufficient non-retirement savings, these mandatory withdrawals can create an unwanted taxable event. Financial advisors frequently point out that RMDs can complicate income planning in retirement, affecting everything from Medicare premiums to eligibility for certain tax credits. What starts as a good problem, having abundant savings, can become a complex tax liability. The age for RMDs has evolved, demonstrating governmental flexibility but also the enduring principle of eventually taxing deferred assets. For decades, the RMD age was 70.5. The Secure Act of 2019 pushed it to 72. Most recently, the Secure 2.0 Act of 2022 further delayed it to 73, and eventually to 75 by 2033. This consistent adjustment by Congress acknowledges longer lifespans, yet the core mechanism remains: the government will eventually collect its taxes. These changes, while offering a few extra years of deferral, do not fundamentally alter the inherent cost of required distributions, merely postponing it. The asset remains subject to forced withdrawal. For those with significant assets and estate planning goals, tax-advantaged accounts introduce another layer of complexity and potential hidden costs. While beneficiaries of traditional IRAs and 401(k) often receive a tax deferral, they generally do not receive the step-up in basis that applies to inherited taxable brokerage accounts. This means heirs must pay income tax on withdrawals of the inherited retirement account. Estate planners frequently highlight that this can be a crucial distinction, as the absence of a step-up can lead to substantial, unexpected tax liabilities for beneficiaries, particularly for large estates. The tax benefits for the original owner might not translate seamlessly to their heirs. In a taxable brokerage account, if you inherit assets, their cost basis is typically adjusted to the market value at the time of the original owner's death. This is the step-up in basis, and it effectively erases any capital gains that accrued during the original owner's lifetime. Your heirs can then sell the assets immediately with little to no capital gains tax. However, with an inherited traditional IRA or 401(k), there is no step-up. Each dollar withdrawn by your beneficiary is treated as ordinary income. The IRS effectively views the deferred taxes as still owed, making it a less tax-efficient inheritance vehicle compared to certain taxable accounts for highly appreciated assets. Let's compare the impact on heirs. If a beneficiary inherits $500,000 in a taxable brokerage account with a stepped-up basis, they could sell those assets the next day and pay minimal or no capital gains tax. In contrast, if they inherit a $500,000 traditional IRA, they're typically required to withdraw the funds over a 10-year period, under Secure Act rules for non-spouse beneficiaries, and each withdrawal is taxed as ordinary income. For an heir in a 24% marginal tax bracket, that means a significant portion of that inheritance could go to taxes over a decade, significantly reducing the net amount received. This stark difference, as tax attorneys regularly emphasize, is a critical planning consideration. A core assumption behind traditional tax-advantaged accounts is that you'll be in a lower income tax bracket in retirement. This belief, however, is increasingly being challenged by demographic and economic trends. Many people maintain robust income streams in retirement through pensions, part-time work, Social Security, and other investments. Furthermore, medical expenses, travel, or support for adult children can mean retirement spending is not necessarily lower. The tax bracket myth, as some financial bloggers call it, overlooks the possibility that your future self might be wealthier and thus in a higher tax bracket than your working self, making the tax deferral strategy less advantageous. Consider the growing number of retirees who continue to work part-time, consult, or even start new businesses. Data from the Bureau of Labor Statistics indicates a rising trend of individuals over 65 remaining in the workforce. Couple this with potentially significant Social Security benefits, pension income, and taxable investment dividends, and an individual's retirement income can easily exceed their pre-retirement working income, especially if they had years of lower earning or interrupted careers. In such scenarios, the deferred income from a traditional 401k or IRA becomes taxed at a higher rate than if it had been taxed upfront. The cost here is paying more in taxes than anticipated. Demographic shifts and fiscal realities further complicate the lower tax bracket assumption. With increasing national debt and growing entitlement program costs, future tax rates are anything but guaranteed to be lower. Policy experts at organizations like the Congressional Budget Office routinely project the need for higher tax revenues to sustain government programs. As people live longer, healthier lives, the traditional retirement phase also extends, potentially increasing total lifetime income and keeping individuals in higher brackets for longer. Relying on current tax rates or historical trends for future projections can be a precarious gamble, one that underlies a silent cost. The sheer administrative burden and complexity of managing multiple tax-advantaged accounts can be a hidden mental cost. Deciding between traditional versus Roth, navigating contribution limits, understanding rollover rules, coordinating with employer plans, and complying with RMDs all demand significant time and mental energy. For many, this complexity leads to decision fatigue or, worse, paralysis. As behavioral economists observe, too many choices can lead to no choice, or suboptimal choices, simply because the process is overwhelming. This mental tax, though intangible, can deter optimal financial management and represents a genuine hidden cost. Beyond just making the initial choices, there's the ongoing compliance. Did you contribute too much to your IRA? Did you correctly calculate your RMD? Are you aware of backdoor Roth IRA rules? The IRS publishes hundreds of pages of tax code, and understanding the nuances of tax-advantaged accounts requires continuous education or costly professional advice. This perpetual need for vigilance, or the expense of outsourcing it, is a tangible cost. Financial planning firms report that a significant portion of their client consultations revolve around ensuring compliance and optimizing these complex account structures, indicating the demand for expertise driven by complexity. Finally, an often overlooked factor adding complexity and potential cost is the variation in state tax laws. While federal tax advantages for 401k, S and IRAs are universal, not all states offer the same deductions or exemptions for contributions or withdrawals. For instance, a traditional IRA contribution might be federally deductible but not deductible on your state income tax return. Conversely, some states might tax Social Security benefits, affecting your overall retirement income calculations. For individuals living in or planning to move to high-tax states, these discrepancies, as noted by state revenue departments, can significantly impact the net benefit of tax-advantaged accounts. Consider New Jersey, for example, which historically did not allow a state income tax deduction for traditional IRA contributions. This meant residents received a federal tax break but still paid state income tax on that contributed amount, reducing the overall advantage. Conversely, states with no income tax, like Florida or Texas, amplify the benefits of tax-free growth in Roth accounts. The absence of a holistic view, considering both federal and state tax implications, can lead to suboptimal decisions. This multi-layered tax environment reveals that the hidden cost isn't just about what you pay, but what you could have saved if you'd optimized for both jurisdictions. This exploration brings us to a crucial turning point, the idea that simply maxing out every tax-advantaged account is always the optimal strategy. This common advice, while well-intentioned, fails to account for the unique circumstances, goals, and risk tolerance of each individual. As many independent financial educators now advocate, a more nuanced approach is required. The focus should shift from blindly chasing tax deferrals to strategically integrating various account types, including taxable ones, into a cohesive financial plan that prioritizes net wealth accumulation, flexibility, and control, rather than just gross tax savings. It's about optimization, not just maximization. What most people get wrong is the assumption that tax savings automatically translate to net financial superiority. They conflate tax-advantaged with best. This overlooks the opportunity costs of limited investment choices, the liquidity costs of early withdrawal penalties, the future tax risk of RMDs and unpredictable tax rates, and the administrative costs of complexity. Financial psychologists often speak of anchoring bias, where the initial, strong positive framing of tax benefits anchors our perception, making us less likely to critically evaluate the downsides. It's not that these accounts are bad, but that their true cost is rarely fully disclosed or understood. Ultimately, the optimal allocation of your savings across different account types is deeply personal. It depends on your current income, future income projections, risk tolerance, estate planning goals, potential for early retirement, and even your health outlook. For someone who anticipates a significantly lower income in retirement, traditional accounts might be ideal. For a young professional expecting income growth, Roth accounts could be superior. For someone prioritizing liquidity and control, a well-managed taxable brokerage account, even with capital gains taxes, might offer better overall utility. The key, as expert planners emphasize, is understanding your unique situation, not following generic advice. So, how do you reclaim control? First, audit your existing tax-advantaged accounts. Scrutinize your 401k statements for expense ratios on your chosen funds. Compare them to low-cost alternatives available in retail brokerage accounts. Are there hidden administrative fees? What are the investment options? Financial literacy advocates recommend doing this annually. If your employer's 401k offerings are subpar, consider if you can roll over old 401k into an IRA with better options, or if diverting new contributions to a Roth IRA or taxable account makes more sense. Knowledge is your first line of defense against hidden costs. Second, don't put all your eggs in one tax basket. Diversify your account types. This means potentially contributing to a mix of traditional, Roth, and taxable brokerage accounts. A well-diversified portfolio isn't just about asset classes, it's also about tax classifications. Having money in various wrappers provides flexibility. For instance, if tax rates unexpectedly spike in retirement, you'll be glad to have tax-free Roth withdrawals. If a major financial emergency strikes, having readily accessible funds in a taxable account, even with capital gains, avoids punitive early withdrawal penalties from retirement accounts. This strategic mix offers unparalleled financial agility. Third, undertake a realistic assessment of your future. Project your likely income streams in retirement, consider potential medical expenses, and think about your desired lifestyle. Do you anticipate being in a higher or lower tax bracket? What are your estate planning wishes? These aren't simple questions, but tools from financial planning software to conversations with tax professionals can help create clearer projections. Understanding your future needs and likely tax environment is critical for making informed decisions today, preventing those hidden costs from surprising you decades down the line. Fourth, always consider the whole financial picture, not just isolated account benefits. This includes your emergency fund, debt repayment strategy, insurance coverage, and even real estate. Sometimes, paying down high-interest debt or building a robust emergency fund in a savings account might offer a better return, by avoiding interest and fees, than contributing to a tax-advantaged account with limited liquidity. A holistic approach recognizes that every financial decision impacts others. Don't let the allure of tax savings blind you to other, potentially more pressing, financial priorities that offer greater overall security and growth. The journey through the hidden costs of tax-advantaged accounts reveals a critical truth. No financial tool is a magic bullet, and every advantage often comes with a trade-off. By understanding these nuances, from fees and inflexibility to opportunity costs and future tax uncertainties, you reclaim control over your financial destiny. It's about moving beyond simplistic advice and embracing a strategy that is as dynamic and unique as your own life. The goal isn't to demonize these accounts, but to use them judiciously, with full awareness of their structural limitations and potential downsides. Your money, your life, your informed choices. Ultimately, the power lies in informed decision-making. Don't let the word tax-advantaged lull you into a false sense of security or blind you to the full picture. Probe deeper, ask critical questions, and build a financial strategy that serves your best interests, not just the perceived wisdom. Your financial well-being is too important to be left to assumptions or generic advice. Equip yourself with knowledge, continuously review your strategy, and ensure that every dollar you save and invest is working optimally for you, without any hidden costs silently eroding your future wealth. We've delved into some complex territory today. If this analysis has shifted your perspective or raised new questions about your own financial strategy, we want to hear from you. Share your thoughts and experiences in the comments below. Have you encountered any hidden costs we didn't mention? What's your personal balance between tax advantages and financial flexibility? Don't forget to like this video if you found it insightful, subscribe for more in-depth financial analysis, and hit the notification bell so you don't miss our next deep dive into topics that truly impact your wealth.